PEV versus earnings yield. The inverse of PE ratio is earnings yield, which can be thought of as the earnings price ratio. The earnings yield is the EPS divided by stock price. Its risk is a percentage. If stock A is trading at $10 and its EPS PEM for the past year is 50 cents, it has a P of 20. That is $10 divided by 50 cents. And the earnings yield of 5%, 50 cents divided by $10. Stock A is trading at $20 and its EPS TTM is $2. It has a PE of $10. That is $20 divided by 2. And the earnings yield of 10% is $2 divided by $22. The earnings yield isn't as widely used as a PE ratio. Earnings yield are useful if you are concerned about the rate of return on investment. For equity investors who earn periodic investment income, that may be a secondary concern. That is why many investors may prefer value-based measures like PE ratio. Earnings yield is also helpful when a company has zero or negative earnings. Since this is common among high-tech growth or startup companies, EPS will be negative unless it as an undefined PE ratio denoted as NA. If the company has a negative earnings, however, it will have a negative earnings yield, which can be used for comparison. PEV versus PAG ratio. PE ratio, even when calculated using a forward earnings estimate, doesn't always tell you whether the PE is appropriate for the company's expected growth rate. To adjust this, investors turn to the price earnings growth ratio or PAG. The PAG ratio measures the relationships between the PE ratio and earnings growth to give investors a complete picture. Investors use it to see if a stock price of an overvalue or undervalue by analyzing earnings and the expected growth rate for the company. The PAG ratio is calculated as the company's trailing PE ratio divided by its earnings growth rate for a given period. Since it's based on both trailing earnings and future earnings growth, PAG is often viewed as more informative than PE ratio. For example, a low PE ratio could suggest a stock is undervalued and worth buying. However, including the company's growth rate to get its PAG ratio might tell a different story. A PAG ratio can be termed trail if using historical growth rates or forward if using its projected growth rates. Also, earnings growth rate can vary among different sectors. A stock with a PAG of less than one typical considered undervalued because its price is low relative to its expected earnings growth. A PAG greater than one might be considered overvalued because it suggests the stock price is too high relative to companies' expected earnings growth. Absolute and relative PE analysis also distinguish between absolute PE and relative PE ratio and their analysis. Absolute PE, the numerator of this ratio is usually current stock price, and the denominator may be the trailing EPS. The estimated EPS for the next 12 months, forward PE, or a mix of trailing EPS of the last 2 quarters and the forward PE of the next 2 quarters. When distinguish absolute PE from the relative PE, remember that absolute PE represents the PE of the current period. For example, if the stock price today is $100 and TTM earnings of $2 per share, the PE is 50. 100 divided by 2. Relative PE. The relative PE compares the absolute PE to a benchmark of a range of past PE over a relevant period, such as past 10 years. The relative PE shows that portion or percentage of the past PE that current PE has reached. The relative PE measuring how close the current PE is to historical low. The relative PE will have a value of 100% if the current PE is lower than the past value, whether the past is high or low. If the relative PE measured is 100% more, then tells investors that current PE has reached or surpasses the past value. Limitations of using PE ratio. Like another fundamental metric, the PE ratio comes with a few limitations that are important to understand. Companies that are profitable, no earnings, or negative EPS pose a challenge for calculating PE. These, among analysts, vary about how to go with this. Some say there's a negative PE, others assign a PE of 10, of 0. When most just say the PE doesn't exist until a company becomes profitable. A main limitation of using PE ratio is the comparison of the PE ratio of companies for the various sectors. Companies' valuation and growth ratios vary widely industries because of how and when firms earn their money. As such, one should only use PE as a comparable tool when considering companies in the same sector because it is the only kind that will provide worthwhile results. For example, comparing PE ratio of a retail company and the PE of an oil and gas drilling company will suggest one is a superior investment and is not a constant conclusion. An individual company high PE ratio, for example, will be less cause for concern when the entire sector has high PE ratios. Other pure PE considerations, because companies that can affect both share price and earnings, leverage can skew PE ratios as well. For example, suppose two similar companies differ in debt they hold. The firm with more debt would likely have a lower PE value than the one with less debt. However, if the business is solid, the one with more debt would have higher earnings because of the risks it has taken. Another critical limitation of PE ratio lies with the formula of calculating them. PE ratios rely on accurately presenting the market value of shares and EPS estimates. The market determines the prices of shares available in many cases. However, the sources of earnings information in the company itself, thus it's possible it could be manipulated. So analysts and investors have to trust the company's officers to provide genuine information. The stock will be considered riskier or less valuable if trust is broken. To reduce this risk, the ratio is on measurement analysis review. If a company were to manipulate its results intentionally, it would be a challenge to ensure the metrics were aligned in how they were changed. That's why the PE ratio continues to be a central data point when analyzing public companies. So, no means it is the only one. Alternatives to PE ratios. One PE ratio is a company-use metric. You can also use several alternatives. Such alternatives is the price-to-book ratio. This ratio compares the company's market value to its book value. The book value represents the company's net asset value according to its balance sheet. The BEP ratio is particularly useful for industries with a substantial tangible assets, and a low PB ratio may indicate that the stock is undervalued. Another alternative is the price to sales (PS ratio), which compares the company's stock price to its revenues. This ratio is useful for evaluating companies that may be profitable yet or not in industries with volatile earnings. The PS ratio gives you insight into how much investors are willing to pay per dollar of sales, making it particularly relevant for startups or tech companies with high growth potential but consistent earnings. The last alternative to consider is the enterprise's value to EBIT divided EV/EBITDA ratio. It assesses the company's valuation relative to its earnings before interest, taxes, depreciation, and amortization. The EV divided EV/EBITDA ratio is helpful because it accounts for company's debt and cash levels, providing a more holistic view of its valuation compared to PE ratio. Investors often use the EV/EBITDA ratio to evaluate companies in capital-intensive industries such as telecommunications or utilities. What is a good price to earnings PE ratio? The answer depends on the industry. Some industries tend to have a higher average price to earnings ratio. For example, in November 2025, the communications services select sector index has a PE of 18.90, while it was 32.24 for technology select index. To get a general idea of whether a particular PE ratio is high or low, compared to its average PE other in its sector, then the sector is in markets. Is it better to have a higher or lower PE ratio? Many investors are saying buying shares in companies with lower PE ratio is better because you are paying less for every dollar of earnings. A lower PE ratio is like a lower price tag, making it attractive to investors looking for bargaining practice. However, there could be reasons behind a company's particular PE ratio. For instance, if a company has a low PE ratio because its business model is declining, the bargain is an illusion. What does the PE ratio of 15 mean? PE ratio of 15 means that company's current market value equals 15 times its annual earnings. Put literally, if you were hypothetically buying 100% of the company's shares, it would be 15 years for you to earn back for your initial investment through the company's income profit. However, a 15-year estimate would change if the company's growth or its earnings fluctuate. What is the difference between forward PE and trailing PE? The trailing PE uses earnings per share from the past 12 months, reflecting historical performance. In contrast, forward PE ratio uses projected earnings for the next 12 months, incorporate future expectations. Forward PE is often used to gauge investors' sentiment about the company's growth prospects, while trailing PE provides a snapshot based on actual past performance. What are the limitations of PE ratios? The PE ratio has several limitations. It doesn't account for future earnings growth and be influenced by accounting practices, may not be comparable across different industries. It also does not consider other financial aspects like data levels, cash flow, or quality of earnings. The bottom line, the PE ratio is one of the many fundamental financial metrics for evaluating a company. It's calculated by dividing the current market price of a stock by its EPS. It indicates investors' expectations, helping to determine if a stock is overvalued or undervalued relative to its earnings. The PE ratio helps compare companies within the same industry, such as insurance company to an insurance company or telecom to telecom. It offers insights into market sentiment and investment prospects. However, it should be used with other financial measures since it does